Hi, welcome back. Well, the other stock that will be in focus is ACC, as it will be reporting its Q1 numbers today. Nigel joins in with what the street is expecting. Nigel?
Well, that's right. ACC will be coming out with a set of numbers. And in terms of expectations, we're expecting a bit of a degrowth of around 9% on the top line. The operating profit should see a degrowth of around 6 to around 7% odd. That would mean that the margins will be more or less stable, while profitability is expected to take a hit of around 22% approximately. Now, in terms of the top line, it'll be split up into two, the volumes as well as realizations. And bulk of the hit comes in owing to lower volumes. Volumes are likely to come in down by close to around 9% approximately, and we're expecting the top line to degrow by close to around 9%. Remember, for cement companies, this lockdown came at the worst time possible because the second half of the March quarter is normally supposed to be the best for them. So big volume loss happened out there, and that explains why volumes will be lower. In terms of realizations, well, we'll have to keep an eye out on that front because on a sequential basis, realizations were higher by roughly around 3% odd, and on a year-on-year basis, well, it could be more or less flattish or maybe mildly higher as well. Now, the reason that we're expecting margins to be more or less stable or a little bit higher because there was a price hike on a sequential basis, so that's one factor. Pet coke prices have fallen in line with crude oil prices. That's another factor. And also, we'll have to keep in mind that, in fact, the variable cost will be lower, but there'll be some negative operating leverage that will play out owing to volume loss as well. So we keep an eye out on ACC. Remember, the stock has seen a bit of a rally from the recent low, and valuation-wise as well, fairly well placed, trading at a sharp discount to replacement cost. Back to you guys.
Okay, Nigel, thanks a lot for joining us and giving us all those details. But the global aviation industry is among those worst affected by the coronavirus, and airlines in India are no exception. Major airlines are announcing job cuts and pay cuts as business has come to a standstill. SpiceJet chairman Ajay Singh told CNBC TV 18 that a significant portion of his employees have been asked to go on leave without pay. He, however, hopes that the government will step in to fix the sector's structural issues.
India always reforms in a crisis, and in this crisis as well, we hope that the government will look at all the structural problems that aviation has always had. We are adopting what other airlines are adopting, which is having people painful as it is on leave without pay. We as you know, SpiceJet actually runs a cargo operation, which is reasonably significant now. We are flying 5 freighter aircraft. We are flying a large number of passenger aircraft as cargo aircraft. And to the extent that there is that cash flow, we will, of course, cover costs of salaries of those who are involved in those operations. SpiceJet is an extremely resilient airline. We've gone through downs before, and we've come out of those. And we have absolutely no doubt that SpiceJet will be standing and, in fact, be in a stronger position with all its renegotiations.
All right, that's the word coming in from Mr. Ajay Singh, but let's get in check from the cues coming in from derivative space. Manglam joins in with the cues from the F&O space. Hi, Manglam. Good morning.
Good morning. So yesterday, it was a very choppy day as far as our markets are concerned. The Nifty at one point was closing in towards that 9400 mark and then also closing in towards that 9200 mark in terms of a high and low. And same was the case for the Nifty Bank, where the high was upwards of 21,100 and the low was lower than 20,500 odd. On an institutional basis, we saw gross volumes from both the FIIs and DIIs on the lower side, but both of them ended on the selling side as well. The foreign institutional investors selling about 260 odd crores, 270 odd crores. We had the domestic institutional investors outselling the FIIs and selling close to around 770 odd crores. The Nifty April futures has turned into a discount of 1 point as against a premium of 45 points. But despite that, we saw the FIIs buy in index futures, a mild purchase, albeit just around a 245 odd crore purchase. But what this has done is taken the FII net longs to 51% from 50%. So we were saying that it was at an even keel, but now the longs have a slight edge over the shorts. So the FII longs are at 51%, shorts are at 49 odd percent. In index options, however, FII sold about 100 odd crores, and that was majority of sale towards selling index calls. So that's telling you that any sort of upside may face a bit of resistance. Where does that resistance come in? Well, the most active call yesterday was 9300 call, and for a premium of around 125, that's telling you that yesterday's high of close to 93.91 could be a firm resistance. And at the lower level, we have the 8700 put, which saw some writing. So that's telling you the 20-day moving average would be a bit of a support. In terms of stocks, I'm watching out for Infosys, The 600 put has maximum open interest on the lower side, so we'll keep an eye out on that. And BEL, a lot of long positions added out there.
Okay, Mangalam, thanks a lot for that. But moving on to an important voice in our special series, Wizards of Dalal Street, Ramesh Damani speaks to Director of Inam Holdings, Manish Chokani, on how the world markets are coping with the pandemic and his view on India as well.
The world has never faced a crisis of this sort. And while we read things and we have heard about the Great Depression of 1929, and I lived through the Great Crash of 1987 also, where it fell quite vertically, I think what is going on now is so unprecedented, because fundamentally, while the factories are all there and the farmlands are all there and the people are all there and nothing has been destroyed, it's been like a war. And you don't know how the fundamentals will turn out. If you remember the early 1990s, we went from 19 on the rupee to 31. And you could have technically said India is in a bull market because, the rupee plunged, profits went up. Everything looked okay if you were sitting in, in rupee terms, except you lost purchasing power and the value of gold zoomed, and the rest of the world, sneered at us and said, look, we didn't make any returns in dollars. And I think the shoe is exactly on the other foot now, that the time will be there within the next 12 months where someone will call the bluff of all these guys printing money like there's no tomorrow. When things get stretched to an extreme, like it happened in the tech bubble or it happened in the consumer sector bubble, leadership dramatically turns and it changes, and you're left holding the can because you don't know what happened when things fall by 66% from there. In the US, Europe, Japan, all being in theory completely bankrupt, and also morally bankrupt are the rating agencies of the world, who are not calling the emperor naked, who are refusing to remove their sovereign ratings from investment grade, and they keep, in a sense, trying to put down countries like India, who have been generally fiscally responsible, monetary policy has been responsible, and yet we trade at close to one rung above junk bond, whereas Portugal, Italy, Spain, and the others, including Japan, get the benefit of indulgence, if I could call it that, from the rating markets and the bond markets.
All right, that's all we have on Power Breakfast. Signing up with the news that the fall in SGX Nifty has in fact worsened. It's down around 130 points versus 90 points decline that we were seeing earlier. But you stay tuned. Bazaar Morning Call comes up next.
Checked out the LIC website? Solid info. User